Hello, folks. Steve Lentz here with the Inside Wire here at Discover Options. Welcome. This is March 13th, 2018. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So today I want to just update the return levels of our core butterfly strategy that we rolled out in our curriculum. So we're not going to dive into the exact rules and everything. I just want to take this opportunity to show you what the back-tested returns are. I spent quite a bit of time going back and doing. Well, I'll show you here. I went back and did 2016. What was reported in the curriculum was 2017, and then I'm going to show you also this year as well where we're sitting. Okay, so just as a quick review in terms of the approach that we take, we do a broken wing butterfly approach, and it's offset in the puts, and this is what the expiration risk graph would typically look like. And this comes about from the best practices series we did in the fall of last year, and I did a 5-parter as we explored the best practices taken from several different practitioners of this broken wing approach, and compiled it into a good method that produced the best returns that I've seen back testing wise, and we rolled it out into our level 3 session 6 butterflies class, and it tees off also on session 2 the proper entry and timing of condors and butterflies in terms of what constitutes a good market condition, a favorable market condition for entering SPX butterfly type campaigns. So that's a big part of what we do, and then the way we approach butterflies, and specifically we do a leapfrogging approach rather than making micro adjustments to the butterflies. We have a leapfrog approach whereby we put one on, and then we have a set of targets for the market to hit, which would then trigger, in this case, the addition of a second butterfly like that, and then we have another set of targets at that point, and when one of those gets hit, that triggers the removal of one and the addition of another. So in this case, let's say the market went up, that's going to then require the removal of the first one we put on, and then we add another one, and then this way we just try and keep one of those 2/10 kind of over the current market. And we have in our curriculum, we have a pretty firm set of rules and, time frames as to when we go ahead and execute the leapfrog and what the price targets are and everything like that. Okay, and so there you see the additional price targets. Okay. Let's, in the curriculum, we had 2017 back tested and reviewed, and here was what the market did. The market in the course of 2017 moved up about 19.4%. It was an excellent year for the S&P 500, and had you had the butterfly campaign going that whole time, starting at the beginning of January, and we could see here that the blue bars represent those that are technically qualified market conditions for entering a butterfly campaign. You could see in the course of the year there were just a few weeks where you had the market being one that was not in a proper condition for entering in a campaign. But generally the whole market was blue almost the whole year. And so it was a big year. And in the course of that year, we would have had a 35.1% gain in the execution of our butterfly approach in the course of those trades. And here are the campaigns. And you can see here is where each campaign was started, beginning January 3rd, going on through. And there was one loss in the course of 2017 on a $100,000 account for a gain of $35,125. And here are the total commissions at $1 a contract. And this is taking the midpoint between bid and ask on those, executing your butterfly order in total, and not taking one leg at a time, but putting in butterfly orders. What else we got here? Okay, here's the OptionVue, another one of the reports we have. You can see in 2017 there were 11 trades, one loser, 91% winners, of course, and that one loser was very, very low relative to what the winner was. So a very good 2017. Now, what I've done this last week is I've gone back and looked at 2016, and then I looked at 2018 so far. So let's go and take a look at I'm sorry. Here's 2017's equity curve. Beginning with 100,000, you could see how it ascends real nicely, an annualized return of 35.1%. Okay? Real nice. Now, let's go look at 2016 and review that. Let me get a sip of coffee, one sec. All right. So 2016 has a bit of a different story to it. Right out of the gate, we had a market condition that was not conducive to doing this. And of course, this comes from a lot of our other research dating back a few years, where we were examining what constitutes a good market condition for butterflies and condors. And here you could see the entire, pretty much almost the first 2 months, right until late February, where we did have a blue bar there, and we went ahead and back tested it doing this, and going and implementing our campaign right there on that first blue bar in February. All right, so that took a while, and you can see other parts. You had a whole, roughly a month and a half right here in the fall in 2016 that was not conducive. So the system, the approach we have, did take a break right there and waited a while before entering into the campaign right there, back in mid to late early to mid November. So there was a lot of time where the approach would not have been started. You would not have begun a campaign. So here are the beginning dates of the campaign, beginning on the 25th of February. And you could see here, and really because we avoided those times, going back to that chart, you could see we avoided some very volatile periods here, by doing it this way and staying out. Those two periods in particular, we got caught up in some of this, and it survived nicely, but you can kind of, and that's just kind of the way it turned out in those particular instances. But there were fewer trades, but these worked out very well. When you back test it and take a look, there were no losers, in fact, in the course of 2016. 10 total trades in 10 total, campaigns in 2016 for a $40,000 profit on a $100,000 account. 100% winners in this case. That's the equity curve. And of course, some of the campaigns you could see kind of plateaued here, because during the course of the campaign, you're in the campaign and not necessarily showing profit until later on. And so that's kind of where, and I'm looking at data points, into the middle of each month. Okay, so I'm taking a data point in the middle and end of each month, on the 15th and then the 30th, 15th and 30th, all the way through. Let's see, 40% total return, annualized of 45. Okay, now let's go and take a look at 18. This is where things get a little interesting. And I'm not going to walk us through the blow by blow. I'm just showing you the return so far. Okay, so we had a very, very volatile upside coming right into this. In 2018, we had a qualified condition beginning on January 2nd, where we begin. So far, through mid-yesterday, the market's gained 4.2%, all right, from the close here on the 30th or 31st till yesterday in the middle of the day, a 4.2% gain, but what a rough ride it has been. We have, so far, the butterfly campaigns on a $100,000 account, you would be down $11,000 or so in the course of this of really 3 campaigns. We're in the middle of the 3rd one. But something that's happened that's very unusual, that begs a question that requires some research here, is if you look here carefully from January 2nd, the VIX was at 9.7 right here. And then if you look at the VIX on January 29th, when the market is up at the peak, the VIX had risen to 13.8. So in the midst of the market making it, ascending at a very, very quick pace, the VIX is rising. And in a butterfly approach that we take, and we're not afraid of the upside. If you've been watching, my progression here in researching this, we're not afraid of the upside. We've adjusted our approach so that our butterfly campaigns are not going to lose money on the upside. But what happened here is when the VIX is rising, when we're supposed to be taking profits and making money on the upside, the rising VIX was digging in. Was not good for us. And then we lost, and then when this day happened here, remember that fateful Friday on what was that, February 2nd? On Friday the 2nd, we ended up losing money in the middle of the day because of the rising VIX. The VIX blasted off on that day. Our first campaign ended up, because the VIX blasted off like that, we were down. The rule is that if we're down 5% or $5,000 on our $100,000 account, we're going to get out. And so we would have gotten out in the middle of the day right there. And then near the close of the day, we look up and see if that's a qualified day or not. Now, if you have any inkling of discretion in your trading approach, you probably would have on Friday said, things are just not right. I'm not going to enter in another campaign near the close. Now, I'm sticking to the rules that we have. Come hell or high water, if we're going to be honest about the way we backtest our approach, then we have to then have some integrity and say, what? On that Friday near the close, this was a technically qualified bar. We're going to go ahead and begin our campaign again and implement another campaign because that's what the rules say. So we go ahead and implemented that. And immediately then, of course, Monday comes along. VIX blasts off even more, and market goes way down here. And right around before you can hit that short strike, that was single butterfly that took half our capital was down our 5%. Okay, so boom, boom in 2 days, Friday, Monday. The approach got blasted, and then of course we waited through all this mess and then implemented our 3rd campaign right here, and then we're here so far, and I'll just show you kind of where it's at. So here are the 2 losers, getting in on, let me see, so I did not carve this up well enough. I thought let me go back. I thought we started on January 2nd. I don't know why it says the 9th right there. Anyway, so we lose our 5% right there, and I'm go ahead and taking the extra 584 dig there because of the way the market was moving so quick. And then on the 2nd, entering in on that Friday and then getting blown out on Monday, we take another hit. So I'm just trying to, backtest this with some integrity here. Because we have such two good years where it's showing some tremendous robustness, and then the third one we have. Let me see here. 226 to 39. Yeah. So this is the combined. This is the 3rd butterfly campaign. We're actually up 325 for the total campaign right now. Here's what it looks like now. Or it did get midday yesterday. Okay, so we have a price target here of the short down here, and then the 1% above the strike price there, somewhere around there. So that's where it's at so far. Those are the returns we have going into 2018, and I wanted to back it up to 16. And so we're going to roll out some promotionals on our butterfly approach, packaged together a nice butterfly course, a mini course of 3 or 4 classes. And but to do that, we have to have some good return levels well documented. We'll go back to 15 and 14 in time and play it on out. Any questions? Brian's with us live, and I know that those will get reviewed in the recording as well. No questions, thanks. Okay, Brian, thanks a lot for joining us. Folks, we'll see you next week. Again, you have any ideas for further classes, an inside wire approach, let me know. I'd be glad to take a look. Maybe you've seen a blog out there, or a vlog, V-L-O-G, as the millennials call it. And let me know what you find, and if you want me to examine it, I certainly will. Take care. Have a great rest of the day. Bye-bye.